So I usually scan our buy, hold, sell list for great dividend payers at attractive prices to highlight for members of the Compounding Dividends newsletter every month. But because big investors had to report their current holdings and portfolio changes through 13F filings recently, I figured we'd just cheat off the best investors in the world to see what they're buying. Now, if you don't know, a 13F is a quarterly report that the SEC gets by investment managers who control over $100 million in US stocks, and it's a snapshot of their long holdings at the end of each quarter. So let's dive into three of them and see what kind of interesting opportunities we can find. Now, in November, the S&P barely changed, but we are in extreme fear mode according to CNN's Fear and Greed Index, so that indicates there might be some good opportunities. So the first one I thought was interesting was Visa. They make money by charging fees on payment volumes and transactions across their network. Basically, they're a toll road for digital commerce. So every time you tap, swipe, click, and pay with a Visa card, they get a small cut. So there's a secular trend towards a cashless society that benefits Visa. The sheer volume growth in global consumer spending gives them really great tailwind, and their business model requires very little capital to operate, which means they get high margins and really great free cash flow. They've increased their dividends for 16 years in a row, so they've got a strong commitment to shareholder returns. The 5-year compound annual growth rate is close to 15%, and it's got a low payout ratio of around 21%, so they've got room for future hikes. So I combined railroads here. The two that the super investors were really buying were Union Pacific and Canadian Pacific Kansas City. Railroads are great for cash flow because they're an essential freight transport service. They move all kind of things all over the place, and obviously they have a moat based on their difficult to replace rail networks. To build a railroad from scratch today is nearly impossible. And they're really the most fuel efficient way to move bulk freight over land, which gives them a long term cost advantage over trucking. They've really been kind of focusing on efficiencies. So with things like precision scheduling, scheduled railroading, that's really helping to boost operating efficiencies and margins. And these guys really tend to have a great dividend history. So Union Pacific, for example, has paid a dividend on its common stock for 126 years in a row. Now, the interesting thing about these two in particular is how big their networks have gotten through mergers. So, Canadian Pacific merged with Kansas City Southern in 2023. That became the first single line rail network that connected the US, Mexico, and Canada. And Union Pacific is currently proposing a merger with Norfolk Southern, which would create the first transcontinental railroad in the United States. Last but not least is International Flavors and Fragrances. These guys are a leading global supplier of flavors, fragrances, and specialty ingredients that are essential components in thousands of consumer products like foods, beverages, detergent, fine perfumes, that kind of thing. So they sell these proprietary ingredients through long-term contracts to consumer goods companies. And once one of their ingredients is in a product, their clients rarely switch providers. There's just too much risk that consumers will notice a difference in taste or smell or whatever the component is, and they won't like the change. So IFF has large investments in R&D that keep it ahead of consumer health and so IFF makes large investments in R&D that keep it ahead of consumer and health trends. And the combination of these things, the R&D that it puts in to stay ahead of trends and to make the right ingredients along with the high switching costs means that they have a really stable, repeatable business. They do maintain a track record of paying a dividend, but recent growth has been impacted by major acquisitions and then some integration efforts of those mergers. But the ability to keep generating strong cash from operations is really the foundation for their shareholder returns. And they're currently trading around a 2.6% dividend yield. And if we look at the payout ratio on that cash flow basis, it's low at about 48.2% right now. If you look at the accounting earnings, it's going to be negative. And this is not a stock that's grown the dividend recently, but like I said, that very stable and repeatable business does give them the ability to pay that dividend and to keep rewarding shareholders. So there you go. 3 stocks that super investors have been buying in the last quarter. Hope you enjoyed it. And is this a way you generate ideas? Do you look at 13F filings? And if you do, let me know in the comments. And if there's anything else interesting you've noticed some of these big funds buying, go ahead and put that in there too. Thanks for watching, and I'll see you next time.